What are your thoughts about Tesla stock today? Tesla stock has been one of the most volatile stocks in the market in the past year. Of course, it should also be taken into consideration that the entire technology sector experienced a hit last year. Still, experts are torn about whether to be bears or bulls. Make sure not to miss this. When you see it now, the market is flipped. Tesla will be very busy just being a best-in-class EV company, Chamath Palihapitiya said in 2021. At the time, Chamath Palihapitiya revealed that he sold his Tesla position for capital to invest in other investment ideas. The Social Capital founder and CEO said he exited his bet on the Elon Musk-led electric vehicle company in the last year or so, as the high prices allowed him to generate cash to fund his other ideas. I don't have an infinite pool of capital, so when I have these ideas, the money has to come from somewhere, Palihapitiya said during CNBC's Delivering Alpha conference. In January of the same year, Palihapitiya told CNBC when Tesla was trading at around $800 that the company was a distributed energy business and that the stock could double or even triple again. In 2020, Tesla was one of the biggest winners in the stock market on the back of strong demand for electric vehicles and investors' preference for growth-oriented companies. The shares soared a whopping 743% in 2020. The year after that, the stock underperformed the broader market with a 10.7% gain year-to-date. Palihapitiya said he's still bullish on Tesla, but his thesis on the company has changed a bit. He admitted that he completely underestimated how big the EV market could be. According to him, the market has flipped and Tesla will be very busy just being a best-in-class EV company. Chamath Palihapitiya is a highly successful entrepreneur and venture capitalist in the San Francisco Bay Area. In 2021, he was ranked 10th on the Forbes magazine's list of new billionaires. Palihapitiya founded Social Capital in 2011 to invest in companies in fields being ignored by other venture capitalists like health, financial services, and education. However, the firm has since expanded to invest in tech companies like Amazon, Tesla, and Slack. There is a clear winner in electrification, Palihapitiya said in a CNBC interview in 2019. It is done. That die has been cast. Now the question is, can CEO Elon Musk build the infrastructure? If given time and given patience, I believe that he will. While Tesla faced a lot of challenges, Chamath Palihapitiya said the company's first-mover advantage in electric cars will give it a long-term advantage. According to Palihapitiya, people are focusing too closely on the window dressing of Musk's behavior and not enough on the main course, which is Tesla itself and its competitiveness in the marketplace. He compared Tesla competitors such as Audi's new electric offering to the Zune media player, a failed Microsoft competitor to Apple's iPod. If you get caught up in all this stuff around the edges, he may mistweet from time to time, Palihapitiya said, alluding to Musk's tweets about Tesla production numbers and funding, which have gotten him in hot water with the Securities and Exchange Commission. My point is, who cares? Your job as a smart investor is to separate the facts in the news from the fiction and the noise. At the time, Palihapitiya said he continues to hold Tesla stock because Musk has been able to deliver on promises on a larger scale years down the line. Musk's behavior on Twitter and podcast isn't important, he said, because demand for Tesla cars is strong and exceeds other players in the electric car market. All of that other stuff doesn't matter. It doesn't change the fact that tens of thousands of consumers are buying that car faster than they can get their hands on it. It doesn't change that as soon as you sit inside the car, your definition of what is expected is altered forever, he said. At the end of the day, whether you like his style or not, his substance is irrefutable. Palihapitiya said of Musk, people are betting against his style. Betting against entrepreneurs who are changing the world has never been a profitable endeavor. However, according to a Forbes article, there are 4 reasons why Tesla stock could drop to as low as $50, and one of the reasons would be Tesla CEO Elon Musk's Twitter endeavor. Still, despite sales that are a mere 9% of the sum of Toyota, GM, Ford, and VW at $389 billion, Tesla's market cap exceeds that of those 4 rivals combined. That said, there are those who believe that Tesla stock is a no-brainer buy in 2023. According to them, the disruptive electric automaker trades at a substantial discount to previous highs. Tesla, like many companies today, faces significant near-term challenges like inflation and rising rates, which increase the cost of capital and hurt growth stock valuations. Investors may also be concerned about the activities of the company's CEO Elon Musk, who purchased social media company Twitter for $44 billion in October. Musk notably sold a whopping $23 billion worth of Tesla stock in 2022 to help fund the acquisition. But while stock sales can hurt a company's price in the near term, this shouldn't mean much for fundamental-focused investors. Unlike equity dilution, where new shares are created, the sale of already existing shares doesn't impact Tesla's value relative to its earnings or cash flow. While some believe the Twitter acquisition is a distraction for Musk, this fear also looks overblown. Tesla has come a long way from the spiraling losses that almost forced it to the brink of bankruptcy in 2008. Now that the company is well capitalized and sustainably profitable, one man's managerial skill and tenacity are arguably less important to its continued success. Also, Tesla is becoming a profit machine, standing head and shoulders above its peers in the automotive industry. In Q3 2022, total revenue jumped 56% to $21.45 billion, while net income doubled to $3.29 billion. Tesla's largest rival, Toyota, only generated $3.15 billion in the corresponding period, despite selling 7 times more vehicles, according to Nikkei Asia. However, it is worth noting that Toyota still mainly produces gasoline-powered cars. Still, Nikkei Asia believes that Tesla's edge comes from its strong brand, which allows it to charge a premium for its vehicles. The company's narrow focus on EVs also gives it a streamlined production process compared to traditional automakers, which produce a wide variety of electric, hybrid, and gasoline-powered vehicles. Meanwhile, others believe Tesla's business is slowing after a series of price reductions in China, a move the company's vice president for external relations in China credits to innumerable engineering innovations. Investors should remember that the price cuts come amid a broader auto industry downturn amid high inflation, high interest rates, and consumer confidence. Still, Tesla's management remains optimistic for the long term, expecting vehicle delivery growth averaging 50% annually over a multi-year horizon. In early January, well-known value investor Bill Miller announced his short position on Tesla, telling CNBC that he doesn't think it's worth more than the top 5 automakers in the world combined. However, some argue that Tesla should be valued differently than traditional automakers that are transitioning to the technology, since Tesla enjoys pure growth in the EV industry, while its rivals are cannibalizing their existing products with electric alternatives, a strategy that could cost them total market share over the long term. Also, Tesla enjoys above-average profits. With a forward price-to-earnings multiple of just 23, Tesla is no longer an expensive stock by any stretch of the imagination when considering its growth rate. That number is significantly lower than the NASDAQ average of 25 and falls behind mature value stocks like McDonald's and Coca-Cola, which both boast forward multiples of 26 and 25 respectively. It's hard to see the shares staying this cheap for very long. In light of this, Tesla stock's valuation is starting to look attractive in the context of the business's underlying momentum. While it's always possible that growth doesn't pan out as expected, particularly in the near term as macroeconomic uncertainty potentially leads to some consumers delaying vehicle purchases, the company's recent growth and its exciting product pipeline make a good case for the stock. Of course, there are always risks to owning the notoriously volatile stock, but it may make sense to make Tesla shares a small percentage of your portfolio at this price. Strong growth this year also seems likely when investors consider 2 big catalysts for the business: the expected launch of Tesla's Cybertruck next year and the company's explosive growth in its energy storage business. The company's vehicle production is also going well, with Tesla management saying in the company's third-quarter earnings call that it achieved a production volume of 2,000 cars per week at its new factory in Germany. Its new factory in Texas should hit this same milestone soon, management added. Meanwhile, production at the company's factory in Fremont, California hit record levels during the period. Overall, the company is doing well, all things considered. Free cash flow was $3.3 billion during Q3, up 148% year-over-year. Bolstering its balance sheet is $21.1 billion of cash and marketable securities, up $2.2 billion sequentially. Make sure to subscribe to Tesla stock for more.